well, see the screen and hear me okay. We'll get one of those right sooner or later. Excellent. Okay, Morgan, am I okay to go? Yeah, let's see here. Sorry, I can't hear Morgan, gang.
All right, Rob, you're good to go.
There he
And
is.
yeah, we are very
Okay.
excited. This is the second time that we've had Rob here, and so greatly appreciate you being here. Thanks again to Jeff for doing a great job and Metastock for offering the 30-day trial to everyone. So just to give you a quick background on Rob, if you've been to the trading shows, you've probably had the opportunity to see him. Rob takes place in a lot of the trading competitions, and Rob recently became a trading champion not just in the U.S. but internationally. So won the exhibit, I believe it was in Paris. So congratulations to Rob on that. And Rob, at this time, I'll turn things over to you, and you can take it away.
Okay, great. Well, thank you very much, Gang. Let's go ahead and get right into it. I believe I'm able to speak till 10:45 Central Time, so I'm going to go with that. What we're going to do here is I've got a lot of information. For those of you that know, for me to say anything in 45 minutes is pretty much impossible. So we're going to go ahead and try to get right through this as much as possible because I want to get a lot of content out to you today. Last time I talked to you about my stochastic spike trades that I like to use, and actually those were partly responsible for me helping me win that competition in Paris, France that Morgan was referring to. Now I want to talk to you about one of the tools and techniques, actually the primary tool that I used to win the trading competition here in New York back a few months ago. So trying to give you kind of some of those real world techniques, all right? I'm not going to, of course, risk, gang, there's a lot of risk. We all focus on the reward, but there's a lot of risk as well. So I'll let you pause this later for the recap to read this in the interest of time, but take the time to read it. As far as me, most of you know who I am, and so I won't spend a lot of time going in and going through that. Here is some contact information, though, if you need it for me. Rob at Become Better Trader, and there's our corporate telephone number there. So a lot of great stuff here. We've been able to accomplish a lot over the years, and looking forward to many more years with all of you. So we'll kind of pass on this here. So again, last time the Paris, France competition, we talked about the stochastic spike trade here at Trading Pub. So this time, what we want to do is, like I said, I was fortunately able to win the New York Traders competition here recently, and so what I want to do is share that setup with you this time. Okay, gang? So with that being said, I've got a huge library of things over the years, and what I'm trying to do for you is, rather than having you to be like me and have to buy, tens of thousands of dollars worth of books, DVDs, CDs, and all that other stuff that I accumulated, since my early years in this business. Here's the actual original library of books I checked out when I was a kid, rather than I'm trying to cut to the chase to some of those things that are most near and dear to me in my trading. All right, so I've got lots of different setups here, and last time we were here, we actually discussed you recall the full spikes is what we talked about last time, which was great. And but I said this time we wouldn't be talking about that again. I want to share some additional techniques, and the one we're going to focus on here today is going to be the accumulation distribution breakout trade. Okay. So with that said, let's go ahead and talk first briefly. And again, this is recorded, so but you're welcome to take a screenshot of this now as we go through it in case you want to reference it as we go through the other slides. Okay, but the video is being recorded, so we'll go ahead and we'll go through this because I want to show lots of examples. So what is the accumulation breakout distribution trade? Basically, it's a price action based breakout trade. Okay. Typically, like most of my trades, it's most effective in a trending market, okay? But this particular one happens to be usable in more of a sideways, congestive market as well. But I'll just tell you the primary usage, its primary intent is to go ahead and be in a trendy market, okay? Here's what I'm looking for. What I'm looking for is in an uptrend. I'm kind of taking a look back at like approximately the last 20 bars or so, and I'm looking for ones in an uptrend that are pulling back approximately 50% off their high. or in a downtrend, ones that pull back approximately 50% off the low. And I emphasize approximately because typically, like when I'm scanning for this, I usually go ahead and loosen it up to about 45%. So it's, you'll get less signals with the 50%, and really it's meant to be a rough estimate. So again, an uptrend, I'm looking for pullback bars 50% off the highs. In a downtrend, I'm looking for pullbacks approximately 50% off the lows. Where's my entry? Well, once I identify that zone, it's typically one tick below or above that particular zone. And I'm going to show you lots of examples of this here in just a few minutes, gang. I'm just trying to get right into the meat and potatoes of it, okay? And so where's my exit? Typically, I like to go ahead and trail. I could make a case for that all day long, but suffice it to say, for the purpose of our time together here today, just understand that I like to trail the trades, okay? And where's the stop? Typically, the low is the one tick below the low of the breakout bar or predetermined loss value. Because, for instance, if that bar that broke out ended up being 20, 30 ticks in length, well, you may not want to take a 20 or 30 tick stop on that trade, okay? Many of you, for instance, the average stop in the S&P futures, for instance, is 6 to 12 ticks. The average stop in like the Russell is 12 to 20 ticks, and the Euro similar to the 12 to 20 tick mark in that. So with all the studies that I've done over the years, the number continues to remain the same after all these years. So with that being said, if your entry bar, your signal bar tends to be too wide, you may have to manually adjust that rather than using the one tick below methodology. As far as key points to remember, I want you to think about the concept of rocket fuel, and if it's moved too far, too much of a range in the attempt to break, then that could go ahead and be a real risk factor for you. And I want to show you examples of that, and that's why I'm kind of going through some of this a little bit quicker early on. I saved the about me. Like I said, most of you know who I am anyway. So I just want to go ahead and kind of get right into it here with you this morning, and as I usually like to do. So as we go ahead and again remind, the one thing I want you to remember here is trailing your entries to reduce risks of reversion to the mean. Often these breakout trades will go ahead and revert back down. For those of you that follow my nightly newsletters, I typically tend to go ahead and identify these types of areas of key, breakouts, breakdowns, and I'll show you some really classic examples where it had a great move after it broke out of this area. However, if you didn't trail your stop down, ultimately, anywhere from a few minutes to hours later, it can come down and actually potentially turn into a loss if you don't go ahead and trail up your stop. So I really like to trail the stops, and that's not just on this setup. That's pretty much most of the setups that I have in my arsenal. I tend to like to trail. Okay. Then what I want to do is, watch for the daily 60-minute, 15-minute charts. I want to make sure I'm focusing on those higher time frames to avoid the tunnel vision factor. That is a real key factor here as well. Okay, because if you just look at this on like a 2-minute chart, if you go ahead and focus on the 5-minute chart, then you're going to go and get kind of a tunnel vision and not look at some of the bigger pictures. And I want to show you some of those bigger picture time frames here as well. Okay, so with that being said, here's kind of an existing example, what this looks like here. And so what we're looking for is we're looking for a trend. And how do I identify the trend? Well, I typically like to go ahead and find myself in uptrends or downtrends by looking at like the 20-period exponential moving average. And in this case, gang, that is the black line here, okay? And you see a black and green line. That's the 18-period exponential moving average and the 20-period exponential moving average, by the way. And so what I'm looking for there is I like to see that nice 45-degree angle up, 45-degree angle down. That helps me determine the quality of the trend. So when we have a situation like that, then what I'm looking for, once I identify the uptrend, what I'm looking for is bars that go ahead and pull back approximately 50% off their high in that uptrend. So you'll see various examples that as we're going up here, where we pull approximately 50% off the high. And what I'm looking for then from there is to go ahead and break out above, in an uptrend, I'm looking to break out above that area. So what's actually happening in this situation? Well, what's happening here is that, oops, can you guys see the screen there? Okay, great. So I'm going to go ahead and keep going there. Okay, so I'll keep going there and just then work on the technical issues there, gang. So basically what we have is the concept here is this, that the market goes ahead and meets a short-term challenge point that for whatever reason, whether it's an institutional going ahead and locking in profits from long positions down below, or whether it's somebody thinking that the market's gone too high and now they're interested in going ahead and starting some distribution. So they're in the short term, basically there's enough sell enthusiasm and an absence of buying in the short term that basically not only was the market able to stop going up, but it was actually able to go ahead and start pulling back. Okay, and so that's what I'm looking for. I'm looking for a place where the market not only gets stopped, but it goes ahead and actually then gets pushed back down. So what happens is once we go ahead and get through that area, what that typically is telling me is that the persons involved here, that give me 1 second here, gang. Okay, sure, we'll go ahead and give that a try. So um, I'm being told maybe if I talk slower that might help. So let's give that a try. Basically, what the concept here then is, I'm looking to go ahead and have a market temporarily show me that there's an absence of buyers, or that there's enough selling strength coming in that somebody's convicted enough that they're actually able to drive the price down temporarily. Now, what my signal then is to get back above that area, which shows me that that person who is interested in selling, or the person that, for whatever reason, again, whether they shorted or whether they went ahead and were just selling from pre-existing long positions, that those players are no longer there, and that the market has gone ahead and generated enough buy interest to actually push through that level. So that's where I'm looking at my entry being one tick above those areas. Okay, so hopefully that goes ahead and makes sense. And let's see, Morgan, I'm seeing the questions about audio. Is it okay to continue? I know during our audio check this morning everything was a-okay. Okay, I'm going to keep going then. Great. So just basically then conceptually, I want you to understand that what we're looking for is in an uptrend, we're looking for bars that are going ahead and pulling, 50% off their highs. Okay, and in a downtrend, I'll be looking for bars that are coming back 50% off their lows. So I'm looking for short-term market action that stalls out, and then I'm going ahead and looking to break out one tick above that prior area for, in this case, a long side trade as we're looking at the charts here. Okay, so that's basically what the concept is. And I'm not sure if you guys are seeing my drawing tool. Just to go ahead and make sure, okay, you guys seeing the drawing tool okay? So excellent. Okay, so apologize, gang. Apparently there's some technical difficulties with the software being used here, so just bear with me. Excellent. Okay, so we're going to keep going with that being said. So let's go ahead and look at more examples now. All right, and again, the primary way we're looking for this is in a downtrend. Here's an example where you really did not have a full downtrend yet. This was basically an uptrend. These are different time frames. I just want you, these are different examples of the same concept in different time frames. I wanted you to understand that we can go ahead and use this in a 2-minute, 5-minute, 15-minute, 60-minute daily type environment. It can also be used in a weekly environment as well. Okay. So basically, what we're looking at here is a situation where we have an uptrend, and then we go in and we push down, we come back 50% off the high, and then on this daily chart, we came back through that high. Now, right now, this particular move went ahead and may not look like a lot here as it broke down below this area, but in actuality, it was over 50 ticks. This is a daily chart, so it did go ahead and continue to break down there. Here, you can see the similar things. Some decent moves can come off for these breakdown, breakout levels. Okay, so again, the entry is basically one tick below the low of the accumulation bar. So in a downtrend, I'm looking for bars that come 50% off the low. That's actually the trade. If you guys, for all of you that watched the trading competition in New York a few months ago, that's exactly the trade that I was going ahead and taking at that time. It was gold. This wasn't the actual instrument. This is Russell, but it was gold at the time, and gold was coming down. Gold then popped back up, and I was waiting for it to go ahead and break back down through, and it did, and then it went in and spiked down, and that helped me with winning that competition there. Okay, so basically, so that's what we're kind of looking at with that concept. All right, so let's just continue to look at several more examples here. We come back 50% off the low, we break down through there. Again, typically by one tick for me is what I use. Some people use two ticks. Some people actually front run it and either do it right at the previous low or one tick above. I personally don't like doing that. That leads too often, in my opinion, to opportunities for this to go ahead and retrace back above. Okay, but so from this particular perspective, again, in a downtrend, I want to see it come approximately 50% off the low, and then I'm looking for it to push down below those lows. All right, let's go ahead and continue to look at different examples here. And so as we go ahead and we look over here, this is in an uptrend. Okay, and this is the dollar index in this particular case. So we go ahead and this is the daily 60-minute, 15-minute chart. And so you'll notice here several of the different examples as well. And the reason why I'm sharing these techniques, I generally try to go ahead and share techniques with you that you can take back home and look at and do on your own charting. Does that make sense? So typically, if you guys know, when I do these public events, rather than going ahead and like things for Trading Pub, for instance, I try to go ahead and share things that you can go back home now, because you can go ahead and identify these. You can go ahead and highlight them with your favorite highlighting tool, your horizontal line tool. You can go ahead and draw these on your favorite charting tool. All it is taking a look at price action, and of course, it's easy to see them if you use like candlesticks. So this is a tool and technique that you guys can get, go home and hopefully many of you are at home now, and you can just kind of go in and look here on your Saturday and go back and start hunting these, kind of like many of you said you did, and we're starting to enjoy on the stochastic spike trade that I shared with you during our last event here together. So as we go ahead and we do, look here, we've got more examples of these. Again, you take the 50% off the high, and then you're looking for the breakout. Okay, in this particular one, this was kind of an exceptional move afterwards, but that really is irrelevant. Some of the moves will be small, and that's why it's important to trail up behind it. Some of them will be really wide, because what's happening here in this is, again, this is the situation where a lot of people, the market's been going up, they go ahead and they get caught in a long side trade. It pulls back against them. They get stopped out, and then it goes right back up their way. And so what I'd rather do is wait for that selling to come in, and then wait to see that that selling is no longer a factor. Does that make sense, gang? Okay, excellent. Great. So I just want to make sure that you guys understand the concept there. I'm waiting for the selling to come in, show me where people are interested in bringing this market down, and then show me that they're no longer interested in being buyers or sellers. So great. All right, so let's go ahead and look at this again, and then I want to discuss some other pieces that are important with this. Here again, same thing. When we're rolling over, this is one of those ways. I don't like to go ahead when we're starting to roll over. We've got a rising support channel here. I don't like to short into these areas. If anything, initially there's support areas, so I don't like to go ahead and short into those areas. How do I go ahead and help me determine if we are actually rolling over? This is one of those tools and techniques that I use to go ahead and see if we are actually rolling over. Okay, this is another example of the dollar index again. And so what happened was we were in a nice uptrend, but the trend was changing characteristics. Well, I'm not going to short right here blindly, okay? And so what I want to do is I want to go ahead and wait till it pulls back up and then starts to push back through, okay? And then I'm looking for the the entry. All right. So this could be one of those tools to help avoid being a little bit too early. And that's why I challenge you to kind of go back and take a look at that and see if you start to see some of these patterns. Now as we talk, and of course in the uptrend, we're talking about the rollover here, but you can see this. Hopefully you guys can see these over here. In fact, I'll just point them out, handful of these. So you see the 50% off the highs on the way up. You see them all, okay? And so as we get, as we do that, and then you go ahead and you think about this one tick above, okay, type situation. And then again, your stop is going to go ahead and be right, either one tick below the breakout bar, or you're going to go ahead and have it a predetermined number of ticks in case it's too many ticks involved. So let's go ahead and talk about some more real-world uses of these, the way we identify these accumulation and distribution areas. All right, as we talk about this, now these are going to be snapshots actually from my live trading room, so that's why you're seeing a little time clock on there and stuff like that. These were actual drawings that we took, during the sessions, so you can see some real-world uses of how I'll use this in the live trading environment. And so one of those is basically here, I'll draw out the key levels, and you see this was actually all the same time frame that particular morning. So like I said, this is about 9:03 Central Time in the morning. It's on the Russell, and basically what I did was I showed this live in real time on a 2-minute chart, a 5-minute chart, a 15-minute chart, and then the hourly chart you can see came all the way back up there as well. So as you look at that bar, it came all the way back up there, and then you also had a bar in the backdrop. So what I was showing people here was look at all this accumulation in the backdrop, all right? And so what I said was, because you can imagine, after we were traced back up and we pushed right back down, there were several people getting very interested in going ahead and shorting. Now, with that being said, I said, look, gang, we got a real problem on our hands, though. We're at the daily speed lines, which is a rising support level. We've got the hourly chart showing all this accumulation in the backdrop. We've got the 15-minute chart showing accumulation. We've got the 5-minute chart showing accumulation, and we have even on the 2-minute accumulation. So across all the multiple time frames, what this is showing us is an area where support came into the market. Well, as you can imagine, though, when people start to see this big, quick, long down bar, this big red bar over here on the 2-minute chart, what do we often think about doing? We often go ahead and want to go ahead and take a short, don't we? That's kind of the it's kind of like the Pavlov's dog response. We go ahead, we have a quick move down, we have a quick spike down, especially after a short-term retracement. Then we're like, that's it, I want to jump in. Well, you'll recall that basically, the way I look at this is it's support until broken. And that's a key thing that people need to think about. In the real world, I identify these areas when we come 50% off the low or we're 50% off the high. Okay, so like here, you'll see all these were 50% off the high up here. So if we were to actually go back up, this would actually be distribution. Does everybody see that? Let me draw that out for you, because each of these bars also had a key distribution range right above us. See it? Okay, so basically then as we get back up there, I'm going to go ahead and consider that to be distribution that needs to go ahead and be broken out above. All right, because that's where on multiple time frames all the selling stepped in. So that's a very real world use of this, is also using this generally as a key support and resistance level. And also if you are short, for instance, this is an area where I'd either want to trail down very tightly or just go ahead and exit the trade, just flatten the position, because my expectation is that this is going to be a tough area to go ahead and break. Okay, so let's go ahead and keep looking here. So here's an example in the S&P. You'll see the same thing. Now you'll see the 2-minute chart here. Okay, you see the 5-minute chart, the 15-minute chart, the hourly chart, all going ahead and coming back off these highs. Okay, and incidentally, the market after that had rolled over that day. We never did get through that area, but I wanted to go ahead and show you how you can start to identify these. Okay, and so just go ahead and take your uh, favorite instrument that you like to look at and start spotting these. Now, was there opportunities down below? Absolutely. There was opportunities down below here. You see on the way up in the uptrend, you had multiple bars that came back 50% off the highs. See that? So every time we get above those are fresh entry techniques. Okay, fresh entry opportunities. All right. So that's I just wanted to kind of show this even like with this one without it highlighted here, so you can kind of hopefully start to see them as they start happening here. Now, here's another example that was actually in the live trading room, and so we had the distribution in the backdrop over here, and what happened, you can see, we spiked right back into that area, came right back to the top end of it, but the same place that institution went ahead and was going ahead and selling off, went ahead, they came right back in there, and as soon as it got up to that value area, they went ahead and they distributed again. Okay, so you can bet on the way right back up here, the expectation was that was also going to be resistance. So here it was the resistance originally, right there in that 50% level, and then it was confirmed resistance as we went ahead and we pushed over back up and tried to break through it again later on in the morning. All right. Okay, here's another example. Just trying to hit you with lots of different examples of this in action so you can kind of go back and start to look at it on your own screens, gang. Here, and again, it's something that all of you, every single one of you should be doing and can be doing. Really, you should be looking at it, seeing if it fits your risk trading plan in it's something that you don't have to go buy indicators. I saw some questions there a little bit ago about indicators and like what are all the indicators. Really, honestly, gang, all of these indicators are irrelevant. Initially for the purpose of our discussion today, forget everything on here except for that 20-period exponential moving average and the key breakdown levels. Okay, the accumulation distribution areas. Forget about all the other stuff because today we're not talking about stochastic spikes. We're not talking about triggers or momentum. We're not talking about anything else other than those. I'm trying to give you guys tools that you don't have to go buy a bunch of stuff for. You can go ahead and take it back and start to study it. Okay, does that make sense? And so, with that being said here, what we had was a situation with the Russell. You see on the 15-minute chart how we went ahead and came back, had that distribution bar that came in. Well, then what happened was we came back into that area about 45 minutes, an hour later. And so we were talking about this as about 10:17 in the morning. And so, I highlighted this for people. I said, look, gang, look what happened. We've gone ahead now. We actually locked in a double distribution. It's hard to see because I drew a circle over it at that time. I said these were live screenshots from the room. And what happened though was, so I drew to highlight that this actually became a distribution bar within a distribution bar. So it basically became a double distribution bar. Very powerful, multiple representations of the same message that somebody, some institutional, has got inventory to sell or they don't believe it's going to go any further. Either way, it's sending the same message that I don't want to be thinking about a long side trade until such time as we go ahead and we clear through there. Does that make sense to everybody? Okay, excellent. Great, gang. So let's go ahead and keep on going here. Just look at more examples of this while we still have a few minutes. Basically right over here, similar situation where we went ahead and we had a high. This is in the Russell. This is an hourly chart. So you see here we had a 50% off the low bar, came back up, tested that area, pulled back, then back into the regular session. We came right back up into that area and got knocked down again. Okay. Looking at more examples here. this is a similar situation. Actually, what I want to do is I want to keep, because I can keep showing examples. There's something else I kind of wanted to real briefly discuss. I got lots of great examples of showing this and how the market then will retest these areas. And unfortunately, what we find ourselves often doing is getting ourselves excited. We look at like a 2-minute chart. We look at it as a 1-minute chart, and we get excited as traders. And we find ourselves getting long into a trade only to have it turn right back around against us. And this is where I said you really got to avoid that myopic focus, because what ends up happening here is that you'll see in a 1-minute or a 2-minute chart, because we're traders, right? So many of us use tick charts, 1-minute charts, 2-minute charts. Maybe if you're lucky, you use a 5-minute chart if you're a trader. Well, I go ahead and I want to focus on the higher time frames too. You remember that caveat that I gave you? And I mentioned that, hey, we really want to go ahead and focus on the higher time frames as well and not forget about those. So the what we have over here on the hourly chart was this big fat distribution bar, and as we were coming back into this previous one, you'll notice here over and over again then we basically got distribution within distribution. And so the moral of the story, the caveat here, is that you go ahead and you jump into the trade hoping that it's going to go ahead and, because you're looking at your 1 or 2-minute chart and it looks like, wow, this is great, only to have it whip right back against you. And then, but then if you were to actually look at the higher time frames, you might actually find that, hey, wait a minute, we're actually in a big distribution bar where somebody's been using this whole opportunity for these upswings to actually sell. Does that make sense? This is really an important concept. So because I know so many of us are focused, I get a lot of people asking me, Rob, what's your tick chart settings? Or Rob, what's a 1-minute chart setting? Rob, what's a 2-minute chart? I really don't use a lot of those real super lower time frames. Not that there's anything wrong with that, but what happens is if you don't still keep in perspective the higher time frames, then the risk is you're going to go ahead and find yourself. Let's see. Do you want to try an iBridge and I can call on the cell phone? Morgan, we can do that. I'm happy to help any way I can if there's a problem. I know we did the audio check this morning. You said it was A-OK and everybody said it was good. So I'm not sure what happened along the way, if we got too many people into the system or whatever. But if you want to call my cell phone, I'm more than happy to talk through the cell phone. Okay, gang, bear with me 1 second. I'm going to try to flip over to cell phone here real quick. Okay. Oh, there we go. Hold on 1 second.
All right, hey Rob, you're live.
To the cell phone here, then, gang. So technology is a wonderful thing, right? So as we go ahead and we look at this, I just want to emphasize this point in closing, since I'm not sure who got to hear it or not, but a lot of times we find ourselves going ahead and getting popped out and knocked out of a trade erroneously or unnecessarily. If we were just to go ahead and kind of look at the higher time frames, we'd see, wait a minute, I'm actually in the that even on this 2-minute bar, we went ahead and locked in a distribution level as well. Came a fresh sell signal, a fresh distribution area that now has to go ahead and be navigated through as well. So you got a sell within a sell within a sell, okay, within a sell, even up on the higher time frames. So I just want to make sure before we move on that everybody understands that, because it's really important, and that's why I put that caveat in there earlier about not getting a myopic focus on the 1-minute, 2-minute type charts and actually focusing on the All right. I'm not sure if people are having better experience with the cell phone or the, gang, I apologize. It's not on my end. I've got about 100 megabyte pipeline, into my office. So there must be some technical difficulties. Just trying to help people understand this important concept there. All right. Well, I'm going to keep going there, and because that was an important concept, and I hope that the technology issue did not go ahead and cause that that important note to be lost. So here's an example. Remember earlier I talked to you about the distribution within. So this was last month. This was in March. And so what I was telling people, I was pointing these out. I drew them out, and then I drew these subsequent bands. Well, so then I went in and said, okay, gang, what I'm looking to do then is break above this level right over here. Let me shade it with a little bit of pink so that you can see it. And so basically, the key was to break above that level. Now, this is what happened was, and unfortunately my arrow obscure it just a little bit, but that arrow actually goes up to the pink line. The price actually did that day go all the way up to the target price. Okay, it went all the way up to the target up above, and then, but by the time the day was done, because soybeans were very volatile that day, it came all the way back down to close down the target objective area. But if you didn't trail that up, like we talked about earlier, remember I told you how trailing to me is very important in these, then you watch this thing turn all the way around, come all the way back down, and become a loser by the end of the day. Okay, and that's just another reminder why when you're talking about these types of strategies where you're identifying accumulation and distribution, the biggest mistake in my trading career as far as from a loss perspective, I actually had a profit on the board that day. Before I took that loss, I didn't even go ahead, I didn't trail that trade up. Had I trailed that trade up, I would have walked away with thousands of dollars, and instead I ended up going ahead and taking a loss completely unnecessarily by not trailing. So I'm a big advocate, as you can imagine, personally, for trailing. Okay, and so as we go ahead and we look, this will be something that was familiar to people as well. These, we were talking about these in the nightly videos where I was looking for breakdown below this area. I'd identified this area out, so we had gone ahead and continued to watch this area for weeks out there into the distance, because that's important. This area becomes kind of a longer-term support resistance level. So then what ended up happening here was we did, in fact, go ahead and break to the downside here, and that led to a really nice move. So we watched this as we continued out into the distance. And you recall, I said typically I'm watching these areas, especially on daily charts. On daily charts, I'll actually reference these bars going back much further back into history. Okay, but typically even on an intraday basis, I'm usually watching these approximately 20 bars back for breakouts and breakdowns. All right, so as we go ahead and look, I just wanted real quickly, I can point out about this was a key area that I wanted to then break on an intraday basis. Does everybody see this top blue bar here? Can you see this top blue bar? Well, what ended up happening here was that, so this was a key area that I was looking to break. Earlier then we came back of that distribution zone only to go ahead and roll over. All right, well, so that became the key level the break going forward. Let me see if I can quickly jump through. So what month as well? So this is the same presentation from the presentation. And I talked about single best trade for tomorrow. And what I was looking for was the goal to go ahead and break out above. You see right over here, what do we have? We have those distribution areas that we were going ahead and talking about. Okay, and so we had these distribution areas, and so I was looking to break out above that for a big upside move. All right, well, what ended up happening was that very next morning, remember that blue line that I'd had? The market went ahead, spiked up, and it spiked up quite hard. It ultimately spiked up there about 100 ticks over the next 2 minutes. So that blue line that I showed you on the daily, on that previous chart, and then showed you the distribution area on the distribution areas. Okay, so real quickly, just in brief, since our time is real short, I just want to explain the concept of rocket fuel. And basically that is, if you've got a distribution area in the backdrop, and what we're looking for with that otherwise that uses up all the market energy to get up near the top end of that range, and it's much more likely to go ahead and roll over. So as a case in point, right here, what we don't want to have happen is we get a key area of distribution. So you look at the hourly chart here, you'll notice that we have this key area distribution here. We really don't want this thing to come all the way right back up here and challenge that area in one fell swoop. The reason being is because then you're basically using up all that buy enthusiasm, you're using up all that excitement to get to that level. Then, okay, great. So basically, so the key is because the risk becomes very high then that we get up to that area, and you'll note we'll launch. So we spiked up into the stratosphere, basically. We launched from way down here. We spiked all the way up there. We get a few ticks then above that breakout area, okay? But now you've used up all the rocket fuel. You used up all the buying power. You know, the market went up to decent move. And so then the risk becomes very high. This is where breakout traders especially get it wrong, in my opinion. Is what happens is they allow a big wide range bar to come out. Then they're like, okay, well, I missed all this, and we're breaking above a key level, so I'm going to go ahead and go long. They don't give deference to the fact that we've already gone ahead and moved so far. Okay? So with that being said, it rolls right back over after going a few ticks above because it used up all that rocket fuel right back down by the end of the bar and moved on. So, gang, I apologize. Looks like there was some audio difficulties with the software this morning. John Purser and I are going to be doing a big event for, and if you guys want to join that, hopefully the audio will be a lot better for you. John and I are going to go and be sharing setups along these lines that day. It's free for you guys to go ahead and attend, and hopefully the audio will be a lot better for you. So if you just want to go ahead and come join us there at becomeabettertrader.com, you can click on that and join us. That'll be next Wednesday evening, okay? So I hope that really helped. There was a lot of really important information. It's the same tools amongst many that I use in my live trading room that I used to win the trading competition back there in live in New York, and went ahead, or if you got to watch your recording, whatever, you saw that that's the exact tool and technique. So I'm trying to kind of speak from the heart there to help you guys become better traders, okay? So with that said, Morgan, I'm going to go ahead and turn it back over to you. Gang, thanks for going ahead and staying with me to the end here despite the audio troubles. I appreciate that. Have a wonderful week.
All right, great. Thank you, Rob. And again, guys, sorry about that with the audio. We did record. We'll get the recording posted very soon, and it should be fluid. So as Rob mentioned, you can get his daily videos at the following link. If you go to becomeabettertrader.com, I'll type that in, becomeabettertrader.com. So again, www.becomeabettertrader.com. And if you see that screen over to the right, it says free videos from pro trader Rob Hoffman. You can get those videos there, and has a big event this Wednesday that you can check out as well. So Rob, always a pleasure having you here. We really appreciate you. I greatly appreciate your patience. I know it's no fun, when you're having issues, and appreciate the patience from everyone in the room as well. So Rob is one of our commentators at the Trading Pub. He'll be posting guest posts and content and videos on our website going forward, so we're excited about that as well. And again, we appreciate you guys being here and for all of your patience. Highly recommend you taking a look, getting the free videos at www.becomeabettertrader.com. So again, you can click on that link right there and do that. All right, guys, over to our next speaker. We've got Damon Pavlatos and Linda Rashke that are going to be joining us. So at this time, Damon, if you want to go ahead and get yours and Linda's screen sharing going, you can hit the start desktop sharing. What we're going to do is I'll put a timer up there. We'll do a quick little 2-minute break while Damon kind of gets everything set up. All right, great. Thank you, Rob. And again, guys, sorry about that with the audio. We did record. We'll get the recording posted very soon, and it should be fluid. So as Rob mentioned, you can get his daily videos at the following link. If you go to becomeabettertrader.com, I'll type that in, becomeabettertrader.com. So again, www.becomeabettertrader.com. And if you see that screen over to the right, it says free videos from pro trader Rob Hoffman. You can get those videos there, and has a big event this Wednesday that you can check out as well. So Rob, always a pleasure having you here. We really appreciate you. I greatly appreciate your patience. I know it's no fun, you know, when you're having issues, and appreciate the patience from everyone in the room as well. So Rob is one of our commentators at the Trading Pub. He'll be posting guest posts and content and videos on our website going forward, so we're excited about that as well. And again, we appreciate you guys being here and for all of your patience. Highly recommend you taking a look, getting the free videos at www.becomebettertrader.com. So again, you can click on that link right there and do that. All right, guys,